Rivian is undoubtedly one of the most impressive automakers in the EV startup space. Whether it comes to just selling electric pickup trucks and being the first to market with such an offering, or selling electric delivery vans to the largest e-commerce giant on planet Earth. What Rivian here is doing is extremely impressive and extremely difficult to accomplish. And that well-known fact, folks, was only just further validated after Rivian's stellar second quarter earnings report, where they beat both top-line and bottom-line analyst estimates. This means that at this point, it really isn't a question about Rivian's ability to stay in business or be a viable automaker in this extremely hot market. The question now is just how quickly can it acquire market share in the pickup truck market, as well as all the other SUV and crossover segments that it has laid out plans for. Because as we all know, folks, the electric vehicle market isn't just going to be run by one company. Where Tesla is known for selling affordable mass market vehicles, Rivian can be known for selling heavy duty and adventurous pickup trucks and SUVs, whereas somebody like Lucid can be known for selling extremely high-end luxury sedans. There's space for all these players in the market, and from an investment standpoint, a lot more opportunity for upside over the next 5 to 10 years. Because although the past 3 years have been extremely impressive in the electric vehicle space, as we all know, the work that needs to be done to truly decarbonize this planet is a lot more than has been done right now. So how exactly does Rivian's second quarter earnings stack up against other similar EV companies, and what does it foreshadow as to the company's path towards profitability, building scale, and launching potentially brand new products by 2025? Well, folks, those questions are exactly what I'm going to address in this video. So to start things off, folks, let's dive right in to the financials Rivian outlined in their latest earnings report, as well as their product roadmap and any sort of technological innovations that they expect to invest in over the next 2 years. Right off the bat, folks, Rivian beat both delivery and production guidances for the second quarter, delivering around 12,640 units, over 7,900 in the last quarter. That means that in the first half of this year, they have produced and delivered roughly 24,000 vehicles, which means on an annualized basis, that could translate anywhere from 40 to 60,000 vehicles, which certainly is an extremely significant amount of scale, which is going to be the main lever for achieving profitability for any sort of business. And by far what's more impressive is the fact that for the full year, they increased their production guidance by 2,000 units to 52,000 EVs. This comes in contrast to other automakers like Lucid Motors and even Nikola, who are facing issues with demand, primarily driven by their high cost of product. It's not like that demand is going to stay put for a very long time, because as we all know right now, we are simply in this economic slowdown period as inflation is falling. But Rivian, on the other hand, is clearly witnessing the exact opposite scenario where demand is staying relatively stable. To put these numbers into perspective, Ford sold around 4,400 F-150 Lightnings in the second quarter. Meanwhile, Lucid sold the Lucid Air in around 1,400 units in the last quarter. This means that Rivian is way ahead of some of the other competitors in this space and is clearly the number 2 EV startup ahead of Tesla when it comes to EV production. And this right here is a pretty important differentiator that Rivian can really take advantage of as it tries to build new products. Because, based on their latest J.D. Power reports, Rivian customers are generally having some of the best ownership experiences across the entire segment. This accomplishment, paired with their in-house developed software stack, newly rolling out Adventure DC fast charging network, and their direct-to-customer sales model, is creating a very Tesla-like business experience for those that want to own Rivian vehicles. This strategy is clearly playing really well in the hands of Rivian's production and delivery numbers, and undoubtedly is going to make it second in line to achieve profitability for an EV startup homegrown in the United States. As a matter of fact, Rivian's gross margin on each vehicle sold improved by $36,000 per unit sold in the second quarter. This means that although Rivian is still underwater on each unit it sells because of the underutilization of their extremely high capacity plant, Rivian's business is headed in the right direction. Their losses have narrowed, meanwhile their production guidance has increased at the same time while they're expanding into the likes of Europe with their Amazon partnership for the electric delivery vans. Not to mention the fact that Rivian is also experiencing a lot of cost synergies similar to the likes of Tesla with the Model 3 and Model Y because of this shared platform between the SUV and their pickup truck. This means that they can ramp production faster, reduce cost faster, and introduce a cheaper compact SUV sooner than potentially other competitors. As a matter of fact, all the headlines you see around Rivian's multi-billion-dollar quarterly loss and negative cash flow should all be taken with a grain of salt, as this is something every EV startup has to go through to achieve scale. And as a matter of fact, just in the last 2 months, Rivian has surpassed the market rate that Tesla was delivering its vehicles at when it first started launching cars in the early 2010s. This means that Rivian has to burn more cash to build more vehicles because right now the market is growing faster than it was over the past 10 years. And as I'm sure we all know, Tesla achieved break-even profitability around 100,000 vehicles sold per quarter, which means Rivian still has a lot more opportunity to grow and potentially create new shareholder value. And what's even better is that Rivian is one of the most capitally efficient startups in the market right now. They have an insane amount of cash available, north of $10 billion, with their free cash flow, although in the negative, still staying relatively stable for the last few quarters. Rivian CEO RJ Scaringe has said that they don't need to raise any more capital until at least through the end of 2025. Which means even if Amazon were to not give them any line of credit to sustain their operations, they would have plenty based on their current burn rate. And they expect to simultaneously achieve gross margin profitability in the middle of next year. This is an extremely impressive outlook and performance by a business that is valued at only $16.5 billion if you look at its enterprise value. Although Rivian stock's market cap is $22 billion, if you subtract their net cash position minus all liabilities, they're sitting at a value of $16.5, which falls right in line with what Lucid is sitting at $13.5. That makes this company look extremely cheap and cheaper than even Tesla, which is trading at a market cap north of $775 billion. Because as you can see on an EV to vehicle basis, that puts Rivian at a valuation of $321,000 versus Tesla's $420,000. And although due to their NDA with Amazon, we have little insight into how much money they're making from their Amazon deal, Rivian has a huge opportunity if they can license their EDV technology to other fleets throughout North America. Because as we all know, especially by the likes of FedEx, USPS, and even UPS, the decarbonization goals are stretching far beyond just reducing electricity generation emissions. These companies now want efficient electric platforms that not only reduce emissions, but increase driver retention and reduce operating costs. And Rivian's EDV platform provides the perfect benefit and cost advantages that these companies are really looking for. All these factors come together to really create a unique edge and value proposition for Rivian's business, their product lineup, and their innovation, whether it be launching a new R2 platform over the next 2 years or introducing their new single motor technology carried over from the EDV into their R1T and R1S. All these efficiencies are going to be realized with scale, and right now it seems like Rivian is successfully able to achieve that scale without burning a boatload of money. All these factors come together to make Rivian one of the best investment opportunities in the EV startup space right now, and one of my favorite companies to own going into 2024. But as usual, folks, that is just my take on this situation. Let me know your thoughts on Rivian's latest earnings reports down in the comment section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.